In addition to equity, usually you have to pay people cash, and you need to have some money in the bank to help your company grow, hire those people, get on shelf at retailers, support those retail programs. So with us today to talk about how to fund that growth is Nick McCoy at Whipstitch Capital. Thanks. Take it away, Nick.
Can I use this?
You can use that or the podium.
Okay. Can everybody hear? All right, good. So I know it's late in the day, and I know raising capital is finance, so I promise there's going to be no fractions, no calculus here. Honestly, just about everything I learned in business school is completely irrelevant to what we're going to talk about today and what's going to work for you. So I wouldn't say I wasted my money, but at the same time, it's true. Okay, Whipstitch, Whipstitch Capital, we're an investment banking firm. We don't like to call ourselves that because I think it kind of gives a bad name to what we do in some ways. But we work with companies like you when they get to a large enough size to help you raise money and help you sell to a larger strategic one day. Or sometimes we work with larger strategics in helping them buy companies as well. Usually we start with deals that are $5 million and up on fundraisers and $25 million in transaction value or higher in a merger or acquisition deal. There's some logos here of what we do. We're only focused on healthier, better for you, innovative food, beverage, personal care, supplements. I'd say honestly about 80% of what we do is food and beverage. Let's see, 2017, we did 10 deals. We've got some of the logos here. We now have 6 people, full-time bankers working for my partner and I, as well as a host of strategic advisors. Our clients are spread around the country. I'm in Boston, that's where our headquarters is. We actually have somebody in San Diego, and my partner works in Maine, Mike Bergmeyer. So those are a couple slides of deals, logos you probably recognize, and we can move on to the meat because it's late in the day. Enough commercial, right? Okay, how to raise money. I wish there was a book like this because that's about what you get out of books, and honestly, what's going to work for everybody in this room is going to be different for every company and every person and every situation, and what works today may not work for you in a year. So what I want to focus on are kind of some of the common threads and things that are almost like tools in the toolbox that you can kind of put to work and help you figure out what's going to kind of check all the boxes and and bring in the capital under the best terms. So it's an art and a science, and it's one of the very few things in life that is that, and that's, I think, what makes it so difficult, because there are kind of some scientific pieces, the math and all that, but there's really an art too. And starting off, putting pen to paper is actually somewhat basic. You have to create a plan. You have to think, what am I going to spend the money on? How much do I need? What am I going to do with it? What am I going to achieve? What do I have to show for it afterward? How much do I need? And then, basically, when do I need it? When am I going to need more? And why me? And that's, to Danny's point on team, why you? Because if I went out right now with an idea to go raise money, I probably wouldn't be very successful because I have no track record and I wouldn't have anybody around me to help me. So I'd have to bring in some people who are smarter than me at outsourcing manufacturing or figuring out how to manufacture or source product, because I don't do those things. And so you kind of have to figure that out and figure out how you can convince investors, beyond what your track record is and your personality and passion, how you're going to get this done. And the more you can de-risk it, the better. There's investors for every size capital raise right now, which is great. If we were talking about this 10 years ago in 2008, this would look a little bit different. There would be a really big hole in the middle. And back then, just like today, up to about $1 million in revenue or $1 million in funding size, you're talking to your friends, your family, your ex-corporate network, Uncle John, Aunt Phyllis, et cetera. And to Danny's point, at that point, they're betting almost 100% on you and your idea. You're going to have a little bit of retail sales. You're going to have a little bit of, you're going to have a product in a package. They can taste it. But honestly, they're 90% you and 10% product. When you get to the kind of 1 to 5 million range, which is the middle here, and that's, that's kind of, call it revenue or check size, you get into some larger investors. You have some strategics like 301. Actually, I'd say more strategics have moved into this level over the years since then than others. And at this point, they're betting on some of your early data in your product. So now you're probably at like 60 or 70% you and your team and 30 or 40% data. Because you probably only have data on Amazon or in Natural. It's not in all channels yet, but you've got something to show. When you get to phase 3 here, that's when you're going for your kind of, your real launch check. Your 10 million and up, sophisticated institutional investor with a playbook. And at that point, you're really selling more your data and more your sell through, where you've taken the brand, where it's gone successfully, what you've done right, what you haven't done right. So at this point, you're also going to have a bigger team, whether it's people actually working for you or through your outsourced network. You can outsource sales. Danny went through it all. You can outsource just about everything. At the end of the day, your core competency is branding and marketing. So they're really banking on more what you've done. And how can you de-risk it so that they can make money when you sell? One of the big channels, which is really friendly to younger companies, so I'm going to talk a little bit more about it today because I think it's really relevant to fundraising, is online. And this is something that's really grown, I'd say, in the last 4 or 5 years. But I think thinking about kind of the change with online and what it's doing to kind of the broader food business is pretty remarkable. And I get the question all the time of, are we in a bubble right now? Valuations are high and things are crazy. There's so much money flying around. Do you get worried about it? And I got asked the question yesterday at NCN when I was talking. And the answer is, yeah. I mean, I always worry about a recession, but at the same time, what's really going on now is not 10 years ago when you're sitting here and you're coming up with an organic Cheerio, and that's the value out of your product. Now we have categories that are changing very, very rapidly. We've got like keto products that are out there that weren't there 3 years ago. There's probably 100 million plus of keto products, supplements and ketone salts and things that just weren't selling 2 or 3 years ago. Cauliflower pizza crust, things like that. So categories are changing, and it's creating lots and lots of opportunity at a much, much faster pace. And online is one of the biggest facilitators of it because there's only so many slots in all of the retail boxes that are out there. And consumer preferences right now are changing to the point where they want more specificity, and they're looking for more destination products. And we're going to talk a little bit about what makes online work in a minute, but that's very conducive to online. So consumers now, they're not just looking for better for you, they're looking for lots of specific things that go way beyond that. And that's why there's so much opportunity and so much white space suddenly. Large CPGs, they're still having declining brands. And it's not necessarily that the brands are bad. I mean, customers are aging and they're not necessarily clean. They are cleaning them up, but preferences are spreading out. If you think of the soda aisle as an analogy, and you go back to like 1880, we had Coke. And actually Coke had Coke in it back then. And then, 20 years later, you'd put Pepsi. And then pretty soon you had 7-Up, and that was really innovative, right? And now look at it. There's like 1,000 things. And if you think about kind of the broad food choices, that's really what's going on here. You know what I mean? I mean, we're at a point where in 20 years, there could be 2 or 3 times the number of, SKUs out there that are successful in selling somewhere, and sustainably successful, which is amazing to think of, but it's true. For retailers, this is really tough because they're used to kind of a high volume rate and a certain amount of inches on a shelf, and that's going down. So they have to think of new things like delivery and meal kits and things that bring people in, like 20, 30-year-olds that live in the city that never want to go to a grocery store and do Netflix and Drizzly and get everything delivered. And distribution is also really important too now because it's not just distribution and how you get it to market, it's how you get it to house. And that's really another piece of online, which is important. It gives you a whole nother distribution channel to the customer. So we talk a lot in the office about what makes people work. And we talk a lot about Amazon just because it's convenient and there's lots of data out there. But the common threads of online, and when you're starting your product out, when you're starting early, think hard about if you can fit this mold, because if you can get a lot of sales pretty quickly, and it's simple. All you have to think about is how do I sell this online? And yeah, that's hard. I shouldn't call it simple because it's hard. But it's a lot easier than having to figure out what's a broker, what's a distributor, what's an MCB. God, I billed them for 50 grand and they paid me 12? Really? I mean, you know what I mean? It's like these things happen. So online products, generally speaking, they're successful or making successful are destination products. So that's things that people are looking to find. They go out, they Google something, and your product comes up. Call it, I don't know, a ketone supplement or whatever it might be. It's filling a specific need, Cricket Bar, something like that. Things that are promotable by social media, the things that influencers will specifically kind of glom onto. Things like paleo, keto, things that are very, functional for certain things that people need. That's very, very good for online products because that's how you get people to find your product and get there and actually search it and buy it. Dollar density, which is a really geeky word, but I love it, How much is your pallet going out your door? If you're over $3,000, you're a better candidate for online than if you're less. If you're a salty snack, you could be as low as 1,000. Think about it. Amazon, you have to ship 3 times. They ship from your DC, or from your warehouse, to their DC, to another DC, to somebody's house. So if you've got a truck with 24 pallets that are $1,000 a pallet, the cost as a percentage of that whole truckload is really, really high. But if you've got $10,000 pallets, it's a tenth as much, right? If you're doing supplements or things like that, it gets way up there. So dollar density is important, and think about that when you're doing your packaging and things. Even $500 makes a big difference. Shelf stability, for right now, this is a real factor. Some people have figured it out where you have a frozen product, you can ship ambient and people can freeze on the other end. There's workarounds, but this is, for right now, it's not solved. And then price point. You really want at least a $20 ring. So variety packs, cases, things where people are buying more so that shipping cost can get absorbed either through Amazon's profitability, because on vendor they control your price, or if you're paying shipping or charging it. So with online, and with the fact that we're going to have so many more SKUs and destination products, you now have a second path to exit. And this did not really exist 5 or 10 years ago. Because the fact is most companies exit before they get profitable. Except now, with online, and I've seen this, you can have a company which will grow to 20, 30, 40 million in revenue and actually continue to grow, almost all online, and maybe in some select retail, where they're actually making money, where they're making 2 or 3 or 4 million of EBITDA, and they're in a sector that they've kind of carved out a niche within a white space, and they become a leader in it, and it becomes defensible. So you can actually sell based on your EBITDA, and that is going to grow. We're already seeing consolidation in the big buyers, but we're seeing a wave of kind of new private equity-backed roll-ups and just other fund-backed ventures like Factory, where there's people that are actually buying destination products and EBITDA. So if you're going for the kind of $100 million product to get sold to a big strategic, which is what I think 80% of people are going for these days or more, you have to map out a path to that early on. So I was talking about before, what do you need to do first to raise money? That plan, you need to think really hard, even when you're creating your product set, your initial set of what is this going to look like as a $100 million product. So if I've got whatever, some salty snack, or let's say like a non-pasta pasta, I can go into Spins and I can look in like a vegetable type high protein pasta, and I can look in Spins and I can see per distribution point basically how much sales there are for other people who are in that category, including the big people. And you can work the math out and you can figure that you can get to roughly a 60 ACV in conventional, 60% of doors independently. It's really hard to go beyond that until you get bought by a big strategic. Some categories like eggs, you're never going to get above 35 because it's so much private label. There's just not enough brands. But you can figure out, well, for each of those points, I can see what the other people are selling. So if they're only selling 100,000 per SKU, that's only $6 million, which might be 3 to the company. I've got to have 20 or 30 SKUs, plus my club, plus my natural, and whatever else to get to 100. Can I do that in this category? That's a lot of flavors of whatever you have. So you have to figure out, okay, so maybe that's not going to work, or maybe I have to have a brand that does this in this category and something that's very analogous, be it a different a single serve or whatever else it might be. But planning early about how big can I get is really important, because you don't want to go out and try to raise money with a business plan to sell to a big strategic, and then people do the math and they say, well, there's no way this product's going to get to be more than 20 million unless you're selling 3 times as much as Berea, and that's just, as pasta, and they're the market leader. It's just not going to happen, or nobody's going to believe it initially. So that kind of big math problem is, I think, getting to be one of the most important things of raising money. And it's because these categories are changing so quickly, and there's so much white space in every category, and brands are extending across categories that 10 years ago it was it wasn't simple, but it was, we're going to make a better version of what's out there. Immaculate Baking was a no corn syrup, bakeable, refrigerated cookie. It was a better version than Toll House. It was kind of just following what's there. And today it's so different. People are literally creating categories within categories. So penetration, what channels can you be in? There's, kind of rough store counts here for each channel. I'm sure you've talked about them already today. How much penetration can you get and how much velocity? And that's units per store, per SKU per week, or dollars per TDP, or, whatever when you're looking at numbers. One thing that I really like these graphs here, because these show how markets build. And the kombucha market is one of the most dynamic markets that it's actually one that we pay attention to. We've also had a couple deals in it over the years, so like Kavita. But you can see here the orange is MULO, which is basically conventional grocery and all the kind of mass outlets. Gray is natural, and that's where kombucha started. Unfortunately, we can't go back below 15, but if we had like 2009, it would be like 70% gray, maybe 80. It would be all GTs. And it didn't taste the same back then that it does now. It's much more mainstream. It doesn't explode in your car either when you open it, which it did for me the first time I ever had one. Thank God I didn't get pulled over. The green is specialty, which is always kind of more niche, and then the blue is C-store. And it's really weird. In 2015, look, there's no C-store for kombucha, right? So if you look, going to 17, you can see that the MULO got bigger. You can see that the kind of market followers there, the people who weren't GT, who was a clear leader here, they all took a big share of the market, even though the market grew and so did GTs. The natural space grew less, it was flatter, and C-store was the most rapid, although still very small. And again, that's because it's a cold chain distribution. It takes some time to kind of work its way through. But when you think about if you're creating a category within a category, you also have to think, how is the market going to develop? And there's kind of a lot over the years, you kind of watch these things, there's a lot of different ways that they develop. And you have to figure out, okay, am I going to ever be a natural product? Am I ever going to be a mainstream product? Am I going to be just natural and club and maybe online? And where are you going to sell? And how is that market going to develop over time? So going back to online, in some of the examples here of companies that have done really well, and these are three very different size companies here, but RxBar did, basically kind of laid out the blueprint of this. They started online. They never raised institutional financing. They made money very, very early on. And Kellogg, when they bought them, yes, they paid $600 million for a company with $120 million in revenue, but they said, and this is quoting Kellogg, they're in the second inning of conventional retail, and they really were. I mean, where they sold well because they were heavy in check stands and places in the store that are very hard to get to. But they were selling so much online, even at the time they sold, that Kellogg's figures, well, we can just take this and we can actually get it to 100 ACV. And we can more than double sales probably overnight just doing that. And then they've also extended the brand, obviously, into other things. So it becomes really easy for somebody in Kellogg who is going to have to go and justify that they're going to be able to be successful owning this and not fail. They can go very easily and say with confidence, hey, I can do this. I can double this product. Because, they're not going to get the carry of a private equity person on it, and if it goes badly, it's probably going to be worse than if it goes well. Cauliflower Foods, cauliflower pizza crust, 2-year-old company, all online. No institutional capital yet, very significant growth. Destination product, 3 ingredients, cheese, eggs, mozzarella cheese. There's other things in the market now, but this is kind of a more premium version, and it's got a genuine story behind it. It's going for, kind of the whole keto thing in some ways. So that works. Pink Stork, definitely a destination product. You're pregnant, trying to become pregnant, you're looking at vitamins, you're Googling around for that, you're looking for solutions, they pop up. Dollar Dense, you can sell it online very easily, probably $10,000, $15,000 pallet type things. So there's lots of examples out there if you look for them. I love this slide, and some people actually I've seen in offices have it printed out and pasted on the wall, and that makes me really happy. But this is kind of what drives value. So you get your plan, you do everything else we've been talking about here today, right? And now you're thinking, okay, so what's going to kind of get my scorecard up? And these are really the things. So at the end of the day, big investors want to sell for big prices. They want you to sell for a big price. So they want you to be $100 billion revenue or more inside of a big company. So when they sell you, you're going to be 50 or 60. It's about right. But you have to have a clear path to more. So the bigger you are in revenue, the more you're going to be worth today. This is all about de-risking the exit. Gross margin. The gross margin is the best measure of profitability in this business. Yeah, there are more EBITDA positive companies right now, but they're EBITDA positive because they have gross margins. And a lot of destination products have a 10 or 15 point margin advantage to those that aren't. These online products, they can sell at a premium because people are trying to find them, and they just say, okay, we're going to hold our margin, we're going to hold our price, and people go buy it. Growth. Obviously, the faster you're growing, the more it's velocity-driven growth, units per sales, per SKU, per store per week, the better. If that number's going up 25 or 30% or more a year, it's gold, especially if you're spreading your footprint, because obviously new stores are not going to turn as fast as old stores. Capital efficiency. This is like your report card. So how much money have you raised and how much revenue do you have? And look, everybody makes mistakes early on. Everybody does the wrong thing. Everybody changes their packaging. So if you're in year 3 and you had a really rough 2 years and you blew $4 million because you hired a Costa, when you were only $100,000 in revenue because somebody told you to, and you paid $12,000 a month and it was too early, it happens. These things happen. The last 12 months is really the most important. What did you do with that last $500,000 that you raised a year ago, and what did you get for it, and how, and what didn't work? Brand extendability. Where can your brand go? I mean, you don't really want to be in 8 different places in the store, but you do want to be able to expand. To my point earlier about how big can you get in a category, you want the brand to be able to go other places, different serving sizes, different flavors, different variants in what you're doing. Simplicity. You've got like 5 seconds at Whole Foods to get somebody's attention. You've got 2 in a grocery store. The biggest competition that a lot of people in this industry face is not other companies, and it's not big companies. In fact, sometimes your other company competitors are your best friends because they're doing what your competition is, and that's the customer's alternative. That's the customer's education level, that you're even number 1 out there, that there's a reason for your product, that that you're going to do what you can do for that customer. These things take time. Price point, you want to be a premium, you can't be unaffordable. Frequency of usage, snacks and beverages get big multiples. And the reason is it's because you can finish them before you get home from the store. You buy a drink, you're home, it's gone. What are you going to do tomorrow? You're going to go and you're going to buy another one, right? At least when I come home from the store. Velocity, we talked about. Customers. Everybody says their customer is the millennial, but I think if you can dig more into your usage occasion and who your customer really is and when they're using it, and online is great for this, because like just the interaction on your Facebook site and everything else, you can get a lot of information, your Amazon reviews. That's really helpful. It's really helpful in how you promote down the road, what time do you run your demos, things like that. Obviously distribution, the more channels you're successful in, the more value, and team, which team's been beaten to death, so I won't say any more about that. My partner actually wrote an article for BevNet a few years ago where we kind of sat down and we thought about all the things that make people successful in raising money and not. And these are just some timeless points, so we've kind of saved them. But one is go deep and not wide. To the point of your report card, you're gonna change packaging. You're going to make mistakes. It's best to make those mistakes when you're in as few distribution points as possible, because the wider you are, the more it's going to cost. And also, the deeper you go, the more that you can get your velocity-driven growth instead of your door-driven growth. You can prove out what drives, trial. It's really hard to figure that out. You go into Whole Foods, you run a TPR, you get a lift, you do demos. What is it? Is it the demo? Is it the TPR? How deep do you have to go? And all that may not work in conventional. It's going to be totally different. And what works in the East may not work in the West. So if you take your time and you don't go out overnight to every single store in the country, you figure those things out, and you're more successful when you do spread. So you pay this big slotting fee, and it's actually worth it. White space, again, clear idea of where your category is going and where, what's your reason to be. Capital efficiency we talked about. Frequency of usage we did too. Gross margin, again, is huge. Fueling growth. So when you're going to raise money from an investor, and I know this one company, which is just an unfortunate story, you want to have all of the money, or as much of it possible, going to growth and not burn. And look, we're all going to burn money, right? Because we're not profitable. But there's a company I know that just had a bad kind of DNA fit with their investor. And the check came in. It was a $7 million check, and it was supposed to be for, and I'm not using the real numbers here to hide it, but it was supposed to be $5 billion for growth and $2 million for burn. Well, the investor got in and they decided, hey, we're gonna solve these problems here before we kind of really start thinking about growth. And so what ended up happening is it was $5 million for burn and $2 million for growth. So when they go to raise more money, guess what? The report card looks awful. And it ended up just being very toxic for the company. So the more money you can raise for growth, the better. If you think you're going to burn $1 million in the next 12 months, don't raise 2, raise 4 if you can do it, because that's $3 million for growth. I guarantee you're going to have a better outcome. Create permission. Again, that's going across categories and team. Okay, so this is the only math we have to do. And this is why nothing I learned in business school matters. When you go for your $10 million check, it's real simple. The way investors are doing your value is they want to triple their money. So they're looking at what am I going to sell you for in 5 years? And if I triple my money in 5 years, that's a 25% return, which is about the hurdle rate that they run at. If you're a little bit of an odd duck, a little bit riskier, whatever, the 3 might become 4. If you're super competitive, it might become 2.5. But this 3 has kind of been around for a long time. So if you want to think about what's your value today, it's on the right here. If you're raising $10 million and you can get to a $90 million exit, well, the pre-money is going to be 20 because 30 times 3 is 90. 20 is your pre, plus 10 is your post. And that's really as simple as it is. The hard part is this. You need to get that investor convinced that they're going to sell that for $90 million, which means that you're going to go in with a set of projections which look great, and they're going to get haircut and butchered. And the less risky you can make those projections, the more that you can show through your data and what you've done that what you're saying is going to happen, the less the haircut. The less the haircut, the higher the dollar number at year 5 when they figure out what they sell you for, and the more aggressive they think buyers are going to be. That means you get a better value today. And that honestly is, when we're working with clients, that's what we spend at least half of our time with, is how do we de-risk this plan so that there's as little haircut as possible, there's as little risk as possible in everything that we're going to do with this check in the next 5 years. There's another darker side of valuation, and that's structure. It's like a Dr. Jekyll and Mr. Hyde, and I have to talk about it quickly because there are some traps here. So if the world was idealistic and there was no war and donuts were great for you, we would all be able to go and raise money in common stock, and we'd never have to sell a preferred share, and that would be great. But that's not realistic, right? Ironman athletes do not succeed by eating lots of cheesecake. It just doesn't happen. So unfortunately, we have to issue preferred, but we want to issue the most simple preferred possible, and that's going to be at the expense of value. Preferred stock means if I invest $10 million in a company, then and the share price goes down, I get my $10 million back before you, the common holders, get anything else. If the share price goes up, I convert, and I'm riding along you and in the next train car. A 2x preferred means if the share price doesn't double, in other words, I get twice my money back unless it doubles before you get anything. So you can see what happens in a $50 million exit valuation here where you did straight preferred. There's no ouch. I'm right with you proportionately. But you can see in the $50 million exit with 2x preferred, you're getting hurt. Instead of getting 53, or 33, I can't read, you're getting 30. So yeah, you might have had a little bit better value up front, but it hurts you there. And by the way, the structure that you take in round 1, it's only going to get worse as it gets bigger. New investors always want at least the structure you have or worse, or they want you to buy out the old structure, which can be really expensive. You don't want to do that. So you can really pay 2 or 3 or 4 times for an early decision to take on something complex. The worst is participating preferred. Participating preferred is I get paid my $10 million, and then after that, I'm basically with you at the same time no matter what. So the share price can go up. I still get my $10 million first. And sometimes I get what's called a pick or more shares, and there's all kinds of things that can make it even more gross. But this is very tempting because you can literally get 2 term sheets from an investor, and one's a 12 million pre and another's an 8 million pre. And the 12 million pre is participating preferred, and they can show you graphs and things that'll show you that you're going to do much better with it, and in some cases you would. And the 8 would be the straight preferred, and I would take the 8 all day long. It's in some people, I mean, there's a little bit of an ego hit. It's like, geez, I only created $8 million of value so far, but don't make the mistake. Don't fall into the trap if you don't have to. The participating preferred is worse in every case than regular. I have 18 seconds left, so I'm just going to very, very quickly tell you that there is a big trend of strategics right now doing funding in what's called two-step deals, where they will come in and they'll invest in you today, and they might buy somewhere between 0 and 50%, and there's going to be a distribution deal or some other kind of commercial deal alongside of that, and there's going to be an option to buy, or some other structure where they're contemplating buying you at some point like 3 or 4 years down the road. That's how we sold Kavita to Pepsi. The original deal was June of 13. They bought it in December of 16. There's an increasing trend of this, and it's good. There's lots of rationale here I can go through, but I know we're running out of time. So, and it's late in the day. Yes. So I'll cut off. That's my last slide.
That's a great cliffhanger. Thanks so much.